The hammer pattern is a bullish reversal indicator that appears at the bottom of a downtrend, signaling a potential turnaround in price direction. It is characterized by a small body at the top and a long lower shadow, indicating that buyers have started to outweigh sellers during the period of the formation. The pattern suggests that the market is attempting to find a bottom, making it a critical signal for traders looking for entry points for long positions. Traders are encouraged to practice identifying and interpreting the hammer pattern within their trading setups to enhance their ability to spot potential reversals. This involves looking for the pattern in downtrends, followed by a confirmation, a bullish move in the next period. However, it is essential for traders to remember that no pattern guarantees success. It should be used in conjunction with other indicators and analysis methods to make more informed decisions. In conclusion, continuous learning and adaptation are crucial in the dynamic world of trading. The financial markets are constantly evolving, and what worked yesterday may not work tomorrow. The hammer pattern, while a powerful tool, is just one part of a trader's arsenal. Expanding knowledge, practicing, and staying informed about market conditions will aid traders in navigating this ever-changing landscape successfully. Candlestick patterns are key tools for traders and investors who aim to predict market movements and make informed decisions. Originating from Japan over centuries ago, these patterns offer visual cues about market sentiment and potential price moves, making them indispensable in the analysis of financial markets. Each pattern consists of one or more candlesticks, with each candlestick displaying the opening, closing, high, and low prices for a given time period. Traders analyze these patterns to discern bullish or bearish trends in the market. Among the various candlestick patterns, the Hanging Man stands out as a significant indicator of a potential bearish reversal. It appears at the end of an uptrend and is characterized by a small body at the upper end of the trading range and a long lower shadow. This shape suggests that there was significant selling pressure during the period, but buyers were able to push the prices back up, closing near the open. However, the presence of the Hanging Man serves as a warning that the bulls may be losing control and that the trend could reverse. Understanding this pattern can provide traders with a strategic advantage, allowing them to anticipate downward movements and adjust their positions accordingly. The Hanging Man Candlestick pattern is an indication that the market could be nearing a peak, suggesting a potential reversal from an uptrend to a downtrend. This pattern is spotted at the end of an uptrend. It is characterized by a small body at the upper end of the trading range with a long lower shadow and little to no upper shadow. The small body indicates that there is not much difference between the opening and closing prices, while the long lower shadow suggests that the sellers pushed the price down significantly before it closed near the open again. To visualize the Hanging Man without using chart images, imagine a candlestick with a short body at the top and a long wick beneath it, resembling a T shape. This configuration implies that, although buyers initially maintained the price, selling pressure was significant enough to push prices down during the session. However, by the close, buyers were able to push it back up, but not enough to make much of a difference from the open, showing potential weakness in the uptrend. Although the appearance of a Hanging Man pattern signals possible bearish reversal, it's important for it to be confirmed by the next trading sessions. In typical market scenarios, confirmation might come in the form of a downward gap or a long black, bearish candlestick on the following day. This suggests that the sellers have gained control and that the price could continue to drop, confirming the reversal signaled by the hanging man. In summary, the hanging man pattern serves as a warning to investors that the current uptrend may be losing strength and that prices might start to fall. It is crucial for traders to look for confirmation before deciding to sell or short sell based on this pattern alone to avoid making premature decisions based on one indicator. The hanging man is a candlestick pattern that traders and analysts use as an indicator for a potential reversal in a bullish market. It has specific features which help in its identification. The shape of the hanging man is similar to a hammer. It has a small body and a long lower wick. The body's color can be either red or green, although its color is less significant compared to its position and the long lower wick. The wick is typically at least twice as long as the body, signifying that there was significant selling pressure during the trading period, but it ultimately closed near the opening price. The importance of the pattern's position in a trend cannot be overstated for accurate interpretation. For a candlestick to be considered a hanging man, it must appear at the top of an uptrend. This context is crucial because it indicates that despite the ongoing upward momentum, sellers are beginning to exert pressure, potentially signaling the start of a bearish reversal. Demonstrating real instances of hanging man patterns involves examining charts where this pattern forms after a period of bullish activity. On a chart showcasing a steady upward trend, the appearance of a hanging man would be marked by a single candle with a small body at the top and a long wick below, standing out against the preceding shorter candles. It's this distinctive look, coupled with its position after an uptrend, that signals traders about the increasing bearish sentiment in the market, despite the current bullish trend. Understanding the hanging man pattern requires not just recognizing its shape, but also the market conditions under which it appears. This knowledge enables traders to make more informed decisions about entering, holding, or exiting positions based on the anticipated changes in market direction suggested by this pattern. The hanging man pattern is a significant indicator in technical analysis that suggests a potential shift in market sentiment from bullish to bearish. It appears as a candlestick with a small body and a long lower wick, resembling the figure of a hanging man. This pattern occurs after a price uptrend, signaling that selling pressure is starting to outweigh buying pressure. At the core of this pattern is the interpretation of trader emotions and behavior. Initially, during the formation of the hanging man, prices may start at their highest, encouraging optimism among traders. However, as trading progresses, prices significantly drop, creating the long lower wick of the candlestick. This decline introduces fear and uncertainty, indicating that bears are challenging the prevailing bullish sentiment. The small body of the candlestick, reflecting a narrow range between the opening and closing prices, shows that buyers are losing their grip on the market. If the pattern is confirmed in subsequent trading sessions by a bearish continuation, it mirrors a shift in trader behavior. Investors who were once eager to buy might now be considering selling to lock in profits, fearing a further downturn. New potential buyers may also hesitate to enter the market, waiting for more favorable conditions. This collective shift contributes to the bearish reversal suggested by the hanging man pattern. Understanding the hanging man pattern thus involves recognizing it not just as a price formation, but as a snapshot of the changing psychological landscape among traders. It signals a warning that despite recent bullish trends, a reversal to bearish sentiment could be imminent, driven by changing attitudes and decisions made by traders in response to market dynamics. The debate on whether the hanging man pattern is more indicative of a trend continuation or a potential reversal is a significant one in technical analysis. The hanging man is a candlestick pattern that appears at the end of an uptrend, characterized by a small real body, minimal or no upper shadow, and a long lower shadow. The interpretation of this pattern hinges on subsequent market action and the prevailing market conditions leading up to its formation. In instances where the hanging man pattern is followed by a downtrend, it is viewed as a bearish reversal signal. This outcome occurs when, after the formation of the hanging man, prices start to decline, confirming the pattern's predilection for signaling a top or a reversal in bullish sentiment. An example can be seen in a bullish trend where the market is extending to new highs and a hanging man suddenly forms. If the following days or sessions see the price falling below the low of the hanging man, it typically confirms the bearish reversal, as sellers have overtaken buyers and momentum may be shifting. On the contrary, there are scenarios where the hanging man pattern acts as a continuation pattern. This happens when, after the pattern appears, the price does not fall significantly, but instead continues the prevailing uptrend. Such a situation might indicate that, despite the selling pressure implied by the long lower shadow of the hanging man, buyers are still in control and manage to push the prices higher. For instance, after the appearance of a hanging man in the midst of an uptrend, if subsequent trading sessions see the price not only holding but also breaking past previous highs, it suggests the pattern served more as a pit stop in a continuing trend rather than a reversal point. The role of market context cannot be understated when analyzing the hanging man pattern. Volume, the behavior of the market leading up to the pattern, and confirmation from subsequent price action are all critical factors that influence the interpretation of this pattern. A hanging man occurring after a prolonged uptrend with increasing volume on the following decline offers a more potent bearish reversal signal than one that forms during a short-lived rise or lax following sell-off. Moreover, analysts often look for additional confirmation through other technical indicators or chart patterns, which can provide further evidence on whether the pattern will act as a reversal or continuation signal. In essence, while the hanging man has the potential to signal both market reversals and continuations, its reliability heavily depends on other corroborating factors and market context. To understand the implications of a hanging man pattern in trading, we look at additional indicators and conditions such as trading volume, nearby resistance levels, and the trend preceding the pattern. These factors play a crucial role in confirming the bearish reversal signal suggested by the hanging man. Firstly, trading volume is a key indicator. An increase in volume on the day the hanging man appears provides a stronger validation for the pattern. It signifies increased selling pressure as more traders participate in creating the long lower shadow of the hanging man, indicating a shift from buying to selling interest. Secondly, nearby resistance levels are important. If the hanging man pattern forms near a resistance level, it gains more credibility as a reversal signal. Resistance levels are points on the price chart where selling pressure overcomes buying pressure, preventing the price from rising further. A hanging man appearing near such a level suggests the market is struggling to sustain upward momentum and might start moving downwards. Finally, the trend preceding the pattern carries significant weight. For the Hanging Man to be considered a true bearish reversal pattern, it must occur after an uptrend. The pattern signals that despite the prevailing upward momentum, sellers are beginning to outweigh buyers. This dynamic is evident in the small real body and long lower shadow of the Hanging Man, which shows sellers pushed the price down significantly before it closed near its opening price. In conclusion, while the Hanging Man pattern suggests a potential reversal from an uptrend to a downtrend, its significance is strengthened or weakened by the presence of confirming factors such as increased trading volume, proximity to resistance levels, and the nature of the preceding trend. These aspects collectively provide traders with a clearer picture of market sentiment and help in making more informed trading decisions. The Hanging Man is a candlestick pattern recognized for its potential to signal a bearish reversal in the market. This pattern typically emerges at the end of an uptrend. It is characterized by a small body near the top of the trading range with a long lower shadow and little to no upper shadow, resembling the figure of a hanging man. When it comes to predicting market direction changes, the reliability of the Hanging Man pattern has been a subject of historical scrutiny. It is important to note that while this pattern can indicate a forthcoming downturn, its predictive accuracy is not absolute. Market conditions are influenced by numerous factors, and the appearance of a hanging man does not guarantee a reversal. Historical data suggest that the effectiveness of this pattern in forecasting market movements can vary. Moreover, there are limitations associated with relying solely on the Hanging Man pattern for making investment decisions. Financial markets are complex, and a multitude of variables can impact price movements. Therefore, it is essential to undergo a comprehensive analysis that incorporates multiple indicators in conjunction with the Hanging Man pattern to form a more reliable forecasting strategy. Indicators such as moving averages, volume, and other candlestick patterns can provide additional insights, enriching the analysis. Thus, while the Hanging Man pattern can serve as a valuable tool in identifying potential reversals, investors are advised to use it as part of a broader analytical framework. This approach helps in minimizing risks and enhances the probability of making informed investment decisions based on a holistic view of the market conditions. Integrating the Hanging Man pattern with other technical analysis tools can significantly enhance trading decision-making. Let us explore how combining it with the Relative Strength Index (RSI), Moving Average Convergence, Divergence, MACD, and Fibonacci levels can provide a more holistic view of the market. Firstly, the Hanging Man is a bearish reversal pattern that occurs at the end of an uptrend. It signals that selling pressure is starting to outweigh buying pressure, potentially leading to a downturn. However, relying solely on this pattern can lead to false signals. Hence, it is beneficial to use additional tools for confirmation. The Relative Strength Index, RSI, is an oscillator that measures the speed and change of price movements on a scale of 0 to 100. Generally, an RSI above 70 indicates that an asset might be overbought, suggesting a potential reversal or correction. When a Hanging Man pattern appears along with an RSI reading above 70, it strengthens the bearish signal. Moving Average Convergence Divergence, MACD, is another tool that can be integrated with the Hanging Man pattern. The MACD is a trend-following momentum indicator that shows the relationship between two moving averages of a stock's price. A bearish divergence occurs when the stock price records a higher high, but the MACD forms a lower high, indicating weakening momentum. Spotting a hanging man pattern alongside a bearish MACD divergence provides further evidence of a possible reversal. Fibonacci levels, based on the Fibonacci sequence, are used to predict the extent of corrections in a trending market. Traders identify key Fibonacci retracement levels such as 38, 2%, 50%, and 61, 8% to gauge potential support or resistance levels. When a hanging man pattern forms near a significant Fibonacci retracement level after an uptrend, it may suggest that the retracement is about to end and the price could start moving lower. For example, imagine a scenario where a stock has been in an uptrend and encounters a hanging man candlestick at a 61, 8% Fibonacci retracement level. Simultaneously, the RSI is above 70, indicating overbought conditions, and the MACD shows bearish divergence. This convergence of signals from the hanging man, RSI, MACD, and Fibonacci levels provides a strong indication that the uptrend may be reversing. Consequently, traders might consider this as a cue to exit long positions or even to initiate short positions, aiming to capitalize on the predicted downturn. In conclusion, while the hanging man pattern provides valuable insight into potential market reversals, integrating it with other technical analysis tools like the RSI, MACD, and Fibonacci levels can substantially reinforce the accuracy of trading decisions. This approach allows traders to make more confident and informed decisions by providing multiple layers of confirmation. Common errors and misconceptions often arise when traders interpret the hanging man pattern in financial charts. This pattern, recognized by a small upper body and a long lower shadow, suggests a bearish reversal might be imminent, especially after a price increase. However, mistakes in its analysis can lead to incorrect trading decisions. A frequent mistake is acting on the pattern without waiting for further confirmation. The presence of a hanging man suggests potential for a downturn, but it is crucial to look for subsequent bearish trends in the following sessions to confirm the reversal. Acting solely on the presence of this pattern can be premature, since not all hanging man patterns lead to a reversal. Another common error is overlooking the pattern's context. The hanging man must occur after a price increase to be considered a potential reversal signal. Without the prior uptrend, the significance of this pattern diminishes greatly, as it may not indicate a reversal. Volume is also a critical component, often ignored. For a hanging man pattern to signal a strong bearish reversal, it should ideally be accompanied by high trading volume. High volume indicates that the selling pressure is significant enough to potentially turn the market direction. Misinterpreting the pattern's effectiveness based on its appearance alone, without considering the market conditions and the stock's overall trend, is another mistake. The reliability of the hanging man pattern increases when it aligns with other bearish indicators. To improve pattern recognition and analysis skills, traders should 1. Wait for additional confirmation before acting on the presence of a hanging man pattern. This could come in the form of a subsequent bearish candlestick or other technical indicators signaling a downturn. 2. Always consider the context in which the pattern occurs, including the previous trend and market conditions. 3. Pay close attention to trading volumes accompanying the pattern. High volume can strengthen the signal. 4. Combine the Hanging Man pattern analysis with other technical indicators for a more holistic approach to deciphering potential market movements. 5. Practice patience and discipline. Not every pattern will lead to the expected outcome, and it is essential to manage risk appropriately. By avoiding common errors and applying a more thorough analysis, traders can enhance their ability to interpret the Hanging Man pattern and make more informed trading decisions. The Hanging Man is a bearish reversal pattern that appears at the end of an uptrend, indicating that selling pressure is starting to outpace buying pressure. To use the Hanging Man for setting entry and exit points in trading effectively, it is essential to understand its structure and the context in which it forms. The pattern is characterized by a small body at the upper end of the trading range with a long lower shadow and little to no upper shadow, resembling a hanging man. To employ the Hanging Man in trading strategies, traders often wait for additional confirmation before making a move. This confirmation could come in the form of a bearish candle following the pattern, indicating a shift towards a downward trend. An effective entry point could be set just below the low of the Hanging Man, ensuring that the market is indeed following a bearish path. Conversely, an exit strategy could involve setting a stop loss above the high of the pattern to protect against potential reversals back into an uptrend. Case studies where traders successfully utilized the Hanging Man in their strategies often highlight the importance of context and confirmation. For instance, a trader might observe the Hanging Man pattern forming at a significant resistance level after a prolonged uptrend. By waiting for the next day's candle to close lower than the Hanging Man's body, the trader confirms the reversal signal and enters a short position. They might then set an exit point based on previous support levels or technical indicators that suggest a bottom, locking in profits before the market potentially resumes its upward trajectory. Such successful applications of the Hanging Man pattern demonstrate its value as part of a comprehensive trading strategy. It provides an early warning of a potential trend reversal, allowing traders to make informed decisions about entry and exit points. However, it is crucial to remember that no pattern guarantees success on its own. Traders should use the Hanging Man in conjunction with other technical analysis tools and consider the broader market context to make the most of their trading opportunities. The Hanging Man is a bearish reversal pattern that signals a potential reversal in an uptrend. It appears as a candlestick with a small body at the top and a long lower shadow, indicating that the price was driven down before closing near the open. However, there are several variations and similar patterns to the Hanging Man, each with its unique implications in trading. One variation is the hammer, which closely resembles the Hanging Man but occurs in a downtrend rather than an uptrend. The hammer indicates a potential bullish reversal, suggesting that selling pressure was rejected and buyers could be regaining control. Another similar pattern is the inverted hammer, which also appears in a downtrend. It has a small body at the bottom of the trading range with a long upper shadow, suggesting that buyers attempted to push the price up, but were not fully able to sustain the higher levels by the close. Like the hammer, the inverted hammer hints at a potential bullish reversal. The shooting star is another pattern that traders often compare with the Hanging Man. While the Hanging Man marks a potential reversal during an uptrend, the shooting star appears after a price advance and signals a bearish reversal. It features a small lower body with a long upper shadow, indicating that buyers pushed prices higher, but selling pressure eventually forced the price down to close near the open. To understand these patterns in the context of trading, consider a chart where an uptrend is marked by increasing candle sizes, indicating buyer control. If a candle with a small body and a long lower shadow, resembling a hanging man, appears, it suggests that sellers are beginning to resist the uptrend. This is analogous to seeing the first crack in a dam, warning that the upward momentum may soon reverse. In contrast, when analyzing a downtrend, spotting a hammer or inverted hammer signifies that despite the seller's control, buyers are starting to push back, challenging the downtrend. It's like a small rebellion forming within the ranks of a retreating army, indicating a potential turnaround. Understanding these patterns and their implications requires careful observation of price actions and market context. Traders often look for additional confirmation before making a decision, such as waiting for the next candle to close or seeking other technical indicators to support the reversal signal.